Good afternoon, and thank you for joining this Yellowstone Advisory webinar. Today's company presenting is Capita. I'm now going to hand over to Stuart Morgan, Head of Investor Relations at Capita, to start the presentation.
Thanks very much, Alex. So hopefully you can now see the slide deck. I'm going to go through the slides that we presented for our full year 2021 results. And then, as Alex says, I will take some questions at the end. So in terms of 2021, it continued to be a year of challenge and change for the business, particularly with respect to the COVID backdrop. But the key message that we announced at results was that the transformation progress that we started in 2018 was complete. It is now a simpler, stronger business. Operationally, we've got two core divisions, a reduction from around 10 different divisions about sort of 5 or 6 years ago. Those two divisions have strong leadership positions in attractive, large and growing markets. The public service division is slightly further ahead in its transformation. The experience division is an attractive business and has plenty of opportunity, but is about 18 months behind public in that process. We have an operating model that's now in place that creates an environment for further opportunity, further efficiencies and margin development. Financially, we exceeded our disposal proceeds objective of 700 million during the year and ahead of time. That has allowed us to address the immediate liquidity challenge that we identified in 2020, where with our cash commitments and debt maturity obligations in 2021 and 2022, we needed to raise that money. That's effectively pre-funded now and will continue to pay down the debt to meet those obligations. We've also met wider obligations. The pension fund is now an accounting surplus, which gives us an opportunity for better cash flows in the future. And then we continue to dispose of the portfolio division, and depending on how much of that is disposed of by the end of the year, our debt will be materially lower at the end of the year. In terms of the results for 2021, revenue growth is the key driver of obviously revenue, but obviously also margins and free cash flow. We grew for the first time in 6 years in 2021, albeit not by much. There was a continuing impact from COVID in that process, but we're pleased that we did manage to grow the business. We won 3.8 billion of contract value, an increase of just over 30% in the year, and that indicates our ongoing competitiveness and our ability to win work, and that's also reflected in our large and growing pipeline. And then all of that means that in 2022 we continue to target positive free cash flow, obviously sort of with the current scope of the business. And then some of it will fall away as we dispose of portfolio businesses. Moving on to the next slide. As I said, we've announced that the transformation process has finished. That process was focused on simplifying and strengthening an overly complex, underinvested and failing business. We had a poor relationship with our clients. We had a huge amount of financial debt. And we are now a stronger, simpler, more focused, more predictable business. We've invested in the business, in people, in systems, processes, and our capabilities. We're now delivering for our clients. And we've significantly reduced the financial and organizational debt in the business. That means we now have a platform in place. So if you look at where we are, we've delivered the transformation. There is obviously still quite a lot of work left to be done, but we think we've got a good foundation from which to build. As I've just said, two core divisions, both in very large markets growing at around 5% each. We are number one in our respective markets, number one in the sort of the UK government software and IT market, and then in experience we're the number one in the UK and Ireland customer experience market, and we've got a a good position in Europe as well. Good digital expertise. There is a line of progress that continues to be made. We go from BPO, which is more people, towards more digital solutions, and that will be an ongoing process. And then more focused on our clients. So we've organized the business in market verticals where we have expertise. We have client partners who now have significant industry expertise in those verticals. We've got a good reputation for delivery now, and we've got some good solutions for our clients. I'll just now go through the financial highlights of the year. So on slide 7, in 2021, as I said, we delivered some revenue growth despite some ongoing headwinds from COVID. Those were mainly in our portfolio businesses, so travel and events didn't recover to the extent that we thought it would. Enforcement similarly, and a few contracts moved to the right as some execution around finalising those contracts, particularly the BBC one, moved into 2022. Profit improvement was delivered through stable revenues and the benefits of our long-term cost improvement programme. Cash unwound a little bit. So if you remember, 2020 was about preserving cash and saving costs. And 2021, as I say, was a working capital unwind, and the government sort of support payments, not sort of furlough, but in terms of quicker cash payments, reverted to a sort of normal level in 2021. And then net debt was where we expected it to be, where effectively the 500 million of proceeds that we received in 2021 offset the sort of 300 odd of below the line exceptional payments, and I'll come back to those later. And therefore you ended up with a 200 million pound reduction in net debt during the year. In terms of revenue, again, reflecting an overall stabilization of the business, our contract losses are just over 3%, is about half of the levels of attrition we were seeing previously. Scope and volume reductions was a major reduction in the year-on-year COVID contracts that we won in 2020, particularly around some DWP call centre work and some NHS printing work that we did. And then the benefits of new contracts, and particularly the Royal Navy training contract and the job entry targeted support scheme in Scotland, help us to offset and slightly more than offset those losses. In terms of profit, again, I think you'll see firstly that margins on new business is not yet offsetting some of those contract losses, and those losses tend to be more mature contracts and therefore kind of slightly higher margin, and we expect that to cycle through over time. A significant benefit from those transformation cost savings, and that's come from sort of general cost efficiency, operational excellence, property and overhead savings, and we're starting to see a few benefits of the new corporate structure in there. And then again, there's a reinstatement of part of the staff bonus scheme with a partial offset from the holiday accrual process. So overall, a big increase from 5 million in 2020 to 94 million in 2021. Coming to divisional financial performance, again, this shows you that sort of the Capita public service division saw a big improvement year on year, and the improvement in revenue growth is reflected in the improvement in profit. Capita Experience going the other way, and again, the revenue decline puts a bit of pressure on margins, and some of that will continue to unwind in 2022. Conversely, portfolio improving a little bit, not actually to the extent that we expected it to in the longer term, but we think that will improve further in 2022. Slide 11 talks to the reported profit before tax number, so just bridging from the adjusted number to the reported number. Again, here the two main components, or maybe the three main components, are the business exits offsetting the restructuring impact, and also some an onerous contract provision that we took in our our closed book life and pension business. So again, a big improvement in terms of reported profit before tax to a profit of 286 million in the year. Moving on to cash flow and net debt. The cash from operations decreased, as explained earlier, with an unwind of our working capital. We had a small improvement in Capex as some of the transformation Capex came to an end. The below the line payments I referred to earlier, so pension deficit payments, we paid sort of over £300 million now in the last 4 years. That will reduce significantly going forwards. Restructuring charge of just under, or cash payments rather, of just under 70 million, and then VAT. So this was a broadly 120 million deferral from 2020 as part of a government scheme to help businesses in coronavirus. That unwound mostly in 2021, with a little bit now in 2022 that's coming. And sort of slide 13 explains the improvement from 2021 to 2022. So as I say, there's 16 million more of VAT that has now been paid in the first quarter. There are some pension deficit contributions that we agreed with the trustees as part of the last actuarial valuation process. So there's just under £300 million improvement year on year from 21 to 22, which will help drive the underlying improvement in free cash flow in the business in 2022. In terms of strengthening the balance sheet and then improving on the liquidity, we extended the RCF in 2021. We received disposal proceeds. So looking forward into 2022, as I said earlier, that we've effectively pre-funded now a lot of the cash requirements in 22. In terms of the profile during the year, as we pay off the debt, as our working capital requirements unwind, a lot of the improvement in the net debt position will happen at the end of the year. So there'll be a small improvement likely at the half year, but actually most of it will come through at the latter part of the year, with around 200 million due to be repaid in November this year. In terms of sort of the financial guidance, in 2022, we expect revenue growth, which is delivered by sort of the underlying the order book and frameworks that we have in place, with some new business wins and our encouraging pipeline. EBITDA margin, we expect to go down a little bit. That is partly on specific contracts. So the loss of a couple of contracts in 2021, the move of the Army recruitment contract into a different phase of its transformation. And we expect the cost of recruiting and hiring people in 2022 to go up a little bit. Cash conversion will go up in 2022 as working capital improves and as the deferred income normalizes. We expect net debt to EBITDA to go down as we continue to dispose of the portfolio businesses, as I said earlier. In terms of the medium term, again, we expect mid-single digit revenue growth, which is broadly in line with the two divisions, although some parts of that will grow at faster rates than others. An EBITDA margin of high single digits, which, when you then take off the central and overhead components, gives you an operating profit margin of around mid-single digit margins. Cash conversion of around 70 to 80%, which is a sort of a medium-term expectation of how our contracts will unwind through the P&L, as well as sort of cash collection. And then a prudent net debt to EBITDA ratio of about 1 times on a pre-IFRS 16 basis. So moving back to the view of the business going forwards, our purpose, I suppose you call this sort of slide 17, our ESG slide. Our purpose is not only the sort of the right thing we think to do for the business, but also is a license to operate in the markets we do. So having a net zero commitment is a fundamental part of government contracting, and also a lot of the work we do around purpose and social values in the business is also an element of our government requirements in terms of bidding for government work. In terms of our people, we're now an accredited real living wage provider. We are working hard on our gender diversity, and particularly at the top levels of the business, and making sure they go through the whole business. With our clients and suppliers, again, our supplier payment terms improved during the year. Our client NPS remains high, although it did come down a little bit during the year. And then in other areas, again, we like to be a good corporate citizen, so fair tax accreditation remains good, and we look to simplify our tax further during this year. Coming back to sort of delivering the transformation on slide 18, I think here it's important to just remember what Capita was like back in 2018. It was a business that was not delivering for its clients. It had huge amounts of financial and organizational debt, and the governance of the business was not good. We had not invested in the business, and we were chasing revenue just to present an external perspective. Over the last 4 years, we've invested almost £2 billion in the business. We've paid down about £1.5 billion of debt, £1 billion of debt. We've paid about £300 million of pension contributions, and we've spent around £500 million in fixing the business, improving our systems, investing in our systems, and investing in our IT, to the extent now you have a much stronger, more resilient, more reliable business. We've got, as I said earlier, a pension fund that's now in surplus. Our pre-IFRS 16 net debt number is just over 400 million at the end of December. We've got a good reputation for organization or for operational delivery, and we've got the right systems and people in place to drive the business going forwards. In terms of slide 19, we are delivering for our clients, so 99% delivery of our key SLAs during the year. As I said, our client NPS remains high at 29. It's a sort of a significant improvement over the last 4 years. The cash improvement on our major contracts, our failing contracts, has gone up by 100 million. And we're now winning additional scopes of work. So 2.2 billion from existing clients. And I think it's also important to note here that those are on generally better terms than we were doing before. In terms of winning new business, so again, there are a lot of metrics on this slide that all point in the right direction. I think the key thing is that we won £3.8 billion worth of work in the year, a 31% increase. 60% of that was with our key accounts, again, reflecting the good client NPS scores, and around 56% being growth on account and new work. So if you look at where we are in that evolution, we were retaining a lot of work. We're now growing on account, and then that moves to winning new business with new clients where we can. It's also important to note here that we are ensuring that we are doing it on a disciplined basis. So we're targeting, or we're delivering our contract wins at an average net margin of 10%. Now that'll be over the life of the contract, so there will be fluctuations on a year-to-year basis, but over the life of those contracts, they're at a net margin of 10%. And also, we did walk away from around £400 million worth of work last year, where we thought the risk and the delivery of those contracts was not achievable. And again, coming back to the point, we're not chasing revenue anymore. We're making sure that we have a higher quality contract portfolio, which can deliver more reliable outcomes in terms of profit and cash. In terms of slide 21, the objective of this slide was just to show the bridge for growth from 2021 to 2022. So again, we have a substantial underpin of a healthy order book and book of framework contracts. Our transactional revenue typically is around 12 to 13% of our total revenue, and that's a fairly consistent number. And therefore, we need to grow the business. And by growing the business, by growing the pipeline, it's gone up by 7% during the year. we have started the year well with £700 million worth at the date of our results. Obviously, the key contract within that was the BBC renewal, but we also have some further opportunities during the year, not only with existing clients like NHS, DWP, but also with some new clients, and we're hopefully going to announce a couple of contracts in the near term with the utilities sector client and a technology sector client. Moving on to slide 22, obviously the underpin of profit improvement in 2021 was the transformation cost program. So 425 million of savings over the course of the transformation. A lot of that came from the operational improvement in the business. We took out lots of inefficiencies in the management structure as well, taking the benefits of group scale. So again, implementing a better procurement process. We've reduced the property footprint of the business by 25% over the last 2 years. There's been some benefit to that already, but there will be more cash benefits as we go forwards. And then, as I said earlier, starting to see some savings from the new structure. Going forwards, that new structure, that new operating model, we'll see further improvements, and that's what will underpin our margin outlook. So lower overhead, fewer legal entities, that in itself will hopefully deliver a big audit saving. Less intercompany charging. Again, there was an awful lot of inefficiency in the business, in internal processes. And then as the business becomes more digital, there's a shift in the mix, which should drive higher margins the long term as more digital services are delivered through more digital aspects to them. Slide 2023, we just wanted to address the issue of inflation protection as a long-term contract model. We don't see any material impact on the business from inflation. We're protected through index-linked escalators on about 2/3 of our contracts. Another sort of 20-odd% are protected with sort of fixed price elements within the contracts terms. And then around sort of, as I said earlier, 12% of our contracts are transactional and therefore sort of naturally hedged as rate cards are updated to reflect the underlying costs of the business. However, back in December, we did call out the increasing likely cost of people in our business, which is separate from inflation. The challenge here is, I think it's widely recognised that the recruitment market is extremely tight at the moment. There were a lot of people who didn't come back into the workplace post-COVID. There's a particular focus on IT talent in the market, which is an area obviously where we need people from, and also this sort of the employee net promoter scores. And I didn't sort of mention this earlier, but we are disappointed in the employee net promoter score outcome last year. I think there was an element there of change fatigue coming out of COVID. So again, we have spent a lot of time trying to improve our employee value proposition, which will not only help recruit people, but also help our existing workforce. So investing in skills and leadership development, strengthening our sort of internal pay scales. Virtual first, I think, is interesting. So the ability to work from home, we think, gives us access to people with perhaps sort of flexible time commitments who would normally perhaps be lost to the workforce, and we can tap into some of that. And these are people we think can deliver some customer service from wherever they happen to be, and we can retain them longer term in the business. So as I say, focusing on recruitment, training, retaining our people is a cost driver in the short term, but we think will pay dividends in the longer term. Just moving on to our two core divisions now. Capita Public Service obviously had a very good year last year. They restructured slightly earlier than the Experience business. It's a very large business. We think about 12.5 billion market size that we address, growing at around 5%, although some aspects of that are growing faster than others. We're the number one supplier in the UK market. And as I say, this is an attractive place for us to operate. We've organised ourselves into 5 main verticals here. So justice, central government and transport, defence, fire and security, local public services, health and welfare, and education and learning. As also in the experience, it is our insight and ability to understand what our clients want and need that drives our ability to win work in these areas. We've chosen to work here and not in others. We have leaders of these verticals who have long experience. And what we're also doing is moving up the value chain. So rather than being a back office sort of executor of outsourced services, we are the sort of the consult, transform, deliver model that we spoke about in the last couple of years drives some of the, not only does it drive sort of pull through revenue, but it drives the mix and the quality of business opportunities that we have. Transport for London is a good example where the ultra low emission zone extension and the congestion charge extension, it was the largest cloud migration program in Europe last year, and we have executed that on time, on budget, and our client is very happy with that. In terms of experience, again, the experience market tends to be a more global market. Our competitors are global players. Where Capita is competitive is in the UK, where we're the number one operator in the market, and our strong position in Europe, mainly in Germany and Switzerland. As you can sort of see on the graph on slide 27, we are in the sort of the top right quadrant of that graph in terms of sort of leading providers of customer experience services to clients. Again, it's a growth rate of around 5% for the overall market, but growing at about 30% in the digital customer experience market. It's also a market that's only around a third outsourced, and therefore we think there are opportunities as we move into the more digital areas and areas like fintech. So we won a European fintech client at the end of 2021. We've got another technology client that we're hoping to sign up in the near future. So as we demonstrate credentials in these new areas, we expect them to be interesting areas of further growth. Our verticals here are financial services, TMT, and then a bit of a catch-all, a multi-industry, but that focuses quite heavily on utilities, retail, and transport. And those are areas where we think the new divisional structure and the focus on verticals will drive further opportunities as we bring together some of the offerings that we can present to our clients. And on slide 28, we just give an example here of the financial services compensation scheme, where this sort of the digital transformation and the services we provide offer them a big improvement on efficiency, client service, productivity. Slide 21 just highlights where we are in the portfolio division, our non-core division. We successfully disposed of around £750 million worth of businesses through 2021, cash proceeds of which have now almost all been received. We've also announced or rather completed disposal of Trustmarque, which is highlighted as the technology pillar on this particular slide. That leaves around £338 million worth of pro forma 2021 revenue and £27 million worth of net profit in that business to be disposed of. That will materially be done in 2022. There are some businesses like the travel and events business where the disposal timeline will depend a little bit on how that business recovers from COVID during the year. So there might still be a little bit left by the end of the year, but As that all gets disposed, and as I said earlier, as the debt maturity in November gets paid off, and some of the pension contributions are made through the year, you'll see a significant reduction in our net debt during 2022, to the extent that it'll be relatively small potentially by the end of the year. And so in summary, as of the end of 2021, the transformation has been done. The business has gone from being an underperforming business to one that is more reliable, more consistent, and it has the platform in place for financial improvement. It has a much simplified structure of the two core divisions, public service and experience, one slightly ahead of the other, but both major players in their markets with significant opportunities, attractive markets, client-concentric model, focus from being reactive to proactive, deep sector expertise. All of these things will drive pipeline and revenue in 2022 and beyond. The new model is the platform for creating further efficiencies and driving margin and profit improvement. The portfolio disposals will continue to strengthen the balance sheet, which will give us options as we go forwards. And then, as I say, the positive sustainable free cash flow number in 2022, probably important to note that that includes some of the portfolio benefit. So you'll sort of continue to see underlying improvement going through into 23 and 2024. And on that note, Alex, I will happily move on to questions.
Thank you for that, Stuart. A lot to get through there, a lot going on, and it's also generated an awful lot of questions. So we'll come on to those, and I'm going to read those out. And just a reminder, if you do want to ask a question, please type it into the Q&A box at the bottom of your screen, and we'll try and get through as many as we can. But yeah, we've got a lot of questions that come through. A few have been around the portfolio businesses, and I know you covered some of this, but I'll start off by asking, when do you expect the next set of portfolio businesses to complete their sale?
So what we said in March was that we were going to launch another couple of the processes in the first quarter, which has obviously now happened. I don't think we can commit to a time frame on that, but we would potentially expect maybe one of those to have seen some progress by the half year. So I think just in the same way as in 2021, we announced those processes as we agreed the sale. Those typically took perhaps around 6 months on average. So even if we haven't completed the sale by the end of the year, at least most of them hopefully will have agreed a sale by the end of the year.
Okay, thank you. Another question here. What are the timescales for historic loss-making contracts to work through on a year-by-year basis?
It's quite difficult to be other than sort of very general. I mean, I think there are probably a few loss-making contracts in the business. Some of those will be strategic insofar as you might have a loss-making contract that gives you opportunities elsewhere, or perhaps a loss-making contract with one client offsetting a profitable contract with the same client. So I don't think there's anything that's sort of structurally loss-making in the business. It depends also sometimes on the nature of new business that we've won. So for example, the DFRP fire and rescue contract in its first year made an accounting loss of 17 million, but was slightly cash positive in that process. But that's all expected in the cycle of sort of these cash flow of the contracts that I referred to earlier. So as I say, it's very difficult to be general. Contracts tend to take a year or two maybe to get fully up to speed. And then you'd have thought maybe by sort of, let's say on a 5-year contract, years 3, 4, and 5 are probably making kind of normal margins in line with what you'd expect for the business.
Okay. We've had a number of questions come on the dividend and the prospect for a resumption in the dividend. So if I sort of group them all together, I think that the gist of it is, when would you hope for dividends to be resumed? And can you give any indication what level these might be resumed at?
I definitely can't do the latter. I think so. In 2022, the focus of the business is paying off the 200 odd million of debt maturities that we have, and as I said, that won't happen until the end of the year. So it's not going to be in 22. In 2023, I think the key here is when the business has stable, predictable, positive cash flows, that's the point at which we can start thinking about dividends. So potentially 2023, but again, I think that's a decision for the board during 2023.
Okay, thank you. Can you tell us a bit more about the exceptional charges and what they're likely to be going forward?
So, I mean, particularly in terms of free cash flow, what we sort of said is that our free cash flow number is effectively net. Bottom line free cash flow is free cash flow. So the restructuring, there will be a vestigial restructuring cash cost to the business in 2022 that is being absorbed in our guidance. There's still, as I said earlier, 16 million of VAT that will be or has been paid this year. There is still a 30 million pound cash payment to the pension to be paid. Those are all being taken sort of within our reported free cash flow number. So effectively, there are no exceptionals, not the word you can use anymore, but there are no sort of transformation, restructuring costs in the business anymore. Everything is now being reported within our sort of business as usual cash flow numbers.
Okay, thank you. Can you talk specifically about the controls and processes in place and the changes that have been made to ensure there's a greater level of bidding discipline?
So one of the first things we did in the transformation process is to introduce what are called contract review committees. Now, these exist at different levels of the business. I think anything over a 50 million pound contract goes to a group level of scrutiny, and the very biggest go to the board. And then there are further CRCs at divisional level and I think also at business unit level. The process here is to make sure that we understand and accept the risk profile of those contracts. So as I said, there was a contract we walked away from last year where we thought delivery was not achievable within the client's aims, and actually I think that is proving to be correct for the person who won the contract. So much more disciplined in terms of, as I said, the risk profile, pricing, commercial terms, all of that is heavily reviewed before we decide to go through to the bidding level and the client negotiation level.
Okay, thank you. You referenced the December comments about staff costs going up. And a question's come in here that says, is the inflationary impact on staff costs better or worse than you expected back in December?
I think it's broadly in line, to be honest. So there is still clearly a reasonably hot market for talent in the UK and in our other geographies. We recruited 20,000 people last year, so we still have the capability to do it, and that is not changing in 2022. But we also do need to continue to attract and retain people, and we are spending money on doing that. So, yeah, I mean, as expected, is where we are at the moment.
Okay. Can you provide any more details on the pension liabilities and potential future payments?
So what we agreed with the pension trustees as part of the, I forget which year it was, the March 2020 actuarial valuation was that we would pay an additional 30 million in each of the years 2021, 22 and 23, and then 15 million pounds a year for the 3 years thereafter. we also agreed to pay an element of disposal proceeds to the pension trustees. Now, the benefit of funding ought to be that by the time the next valuation comes up, which is in March next year, we would hope, and the position of the fact that the pension scheme is now in surplus and on a sort of a mark to market, perhaps the actuarial valuation is also now positive. Potentially some of those outer year cash payments fall away as we go forwards.
Okay, thank you. You talked about a policy of flexible working in terms of, I guess, targeting staff that, or potential staff that can work from home. Got a question here that says, are your staff back in the office? So maybe you could give us a view what the policy is on getting staff back into the office.
I think the policy is where if the client requirement is that our staff are in the office, then we do that, obviously in a safe and secure way. Otherwise, there is a general principle of virtual first in the business. So, as I said, we've taken a lot of property footprint out of the business, and I think people, I don't have the stat. I think there's a stat that sort of says overall office occupancy is probably at about 25% across a working week at the moment. In parts of the business, it'll be more. In parts of the business, it'll be sort of probably reflective of that. I think there's probably a little bit less office occupancy than perhaps we expected, but that's a positive thing, I think, in many ways.
Does that mean that you've potentially got some more property disposals to come?
Yeah, I think there's still opportunities for consolidation of some of our properties, and as leases come up in the next 3 or 4 years, we'll continue to evaluate the need for some of those buildings.
Okay. Switching tactics a little bit here, or topics. Are you seeing any change in behaviour from clients, both the public and the private, in the way that they select their favoured bidder? Some other contractors have commented that it's no longer simply based on the lowest price. Is this the case for Capita?
We would always want it to be less about price than the quality. I mean, clearly price is an important element, but as I said earlier, things like social value are now an element that you need to address, and the ability to deliver services. So again, the reliability and our improved reputation are very important. So yeah, I mean, I think Capita continues to be out there winning business on the strength of its offering, on the strength of its people. As I say, the experienced business has recently hired some people to lead the verticals who've got 20, 30 years of experience and are able to have conversations with clients about doing more for them perhaps than we currently do. So as I referred to earlier, we win quite a lot of work. We won in 2021 a lot of business that was growth on account. And I think that growth on account is starting to sell better into clients. As I said earlier, being more proactive than reactive, cross-selling and upselling like any business would do. So I think, yeah, there's opportunity there.
Okay. I'm going to move across to valuation now. We've got a couple of questions here, which I'm going to try and group together. And the suggestion is that the city or the market view of the business is behind where it is, pretty negative, and finding it difficult to give a proper valuation to Capita. And there are sort of a number of questions that have followed from that. One is, given that, why would you install an employee bonus scheme? Secondly, why do you think I guess the city, the market, the large institutions put such a low valuation on the business?
I'll start with the second of those. I mean, I think certainly in the institutional shareholder meetings I've had so far, people still want to understand what Capita's pro forma financial outlook looks like. So whilst we are, as I said earlier, clearly a much more simple business to understand. There is still some complexity around Capita. And I think 2022 is a year where we have to execute and deliver. I think we need to sort of regain the trust of the market. So if you put those two together, I think your generalist fund manager doesn't need to look at Capita right now. As things firm up, as the 2023 outlook becomes clearer, that becomes more of an opportunity to think about investing in Capita. I think there, as I said, there are easier businesses to invest in at decent valuations at the moment. That's not to say I'm not talking to people who are very interested at this point. I think in terms of sort of what the employee bonus scheme, I'm not sure that's anything to do with the valuation. I think we think it's important to retain a lot of the people in the business. As I said earlier, it's not, we need to retain and attract people, and the bonus scheme is part of that. So that is why that was paid out in 2021 and is still on offer in 2022.
Okay. What do you think, or what do you see as the biggest risk to achieving the current year profits and EPS forecasts?
We need to grow. I mean, I think part of the disappointment of last year was that we didn't grow as much as we hoped we would and expected to. I think, we started the year in terms of winning some good business. There's always the risk of things moving to the right, as with any contracting business. But we've said that the public business hopefully will grow broadly in line with its markets during the year, and the experience business will stabilize its revenues after a sort of a 9% decline last year. So between the two of those, and if you put portfolio to one side for a second, you'd have a sort of a core business that's growing at low single digits, and I think we're confident we'll do that. And then portfolio should grow at high single digits as some of those businesses really get up to speed again after the impact of the last couple of years.
Okay. If you're a private investor, I think it's quite difficult to get forecasts about Capita. And there's a question here that says, look, there are a lot of things going on. In broad terms, what might the company look like when the disposals are finished? And by that, I mean, pro forma sales, operating profits and pre-tax profits, not a forecast, but, just a simplification of what we're dealing with here.
Yes, and I slight sort of side tack here, but I mean, talking to the sell side analysts, what I'm trying to encourage them to do, and one of them has done, is sort of model what they think the sort of the core business will look like without portfolio. Because one of the things we suffered from last year and will continue to suffer from this year is people sort of knocking out profits as businesses are disposed of, even if we don't think the underlying business outlook has changed. In terms of being able to try and model that, I mean, we gave some guidance in our annual report, both at a group level, but also on a divisional level, that sort of says, look, they will both in the medium term grow in line with their markets. I think high single digit to low double digit EBITDA margins. You've got a group overhead of around 50 million, which hopefully can become a smaller number. Cash conversion of around 70 to 80%, no significant below the line items. So if you put all of that together, you should be able to sort of model what the market is expecting over the next 2 or 3 years. Okay, thank you. And a follow-up question to that is, a request really, could the company consider engaging a research provider such that research is available to private investors? It is on the list of things I'm considering, yeah. Good. Excellent. I'm sure that question there will be pleased with that. So another question here on dividends, we've covered that. When do you expect your current onerous contract provisions to be fully utilised? I think the principle on those onerous contract provisions is that the provision we took last year covers us effectively, along with sort of the existing provision, for the next 2 to 3 years, in which, in one way, shape or form, we would hope to have resolved the life and pensions business unit. Now, I didn't really talk about it earlier, but this is not a business unit that's sort of underperforming for its clients in the way that some of the others were. I think we do a good job. The problem was entering into these contracts was not. We didn't do it in a particularly good way. We didn't structure those well. So despite the fact that we continue to provide a good service for our clients, we don't get the pricing and therefore the margins that you'd want on these businesses. We are not renewing work, so the revenue, profit and cash impact on the business continues to be negative. So, as I say, that onerous contract provision is effectively more about giving us the opportunity to find a strategic resolution and giving us a window to do that rather than anything else.
Okay, thank you. Looking at the divisions, what else needs to be done to turn around the customer experience division so that higher margins can be generated here?
It's a business, as I said, that has you get the real benefits, firstly from global scale and also from some niche capability. So I mean, Teleperformance is the market leader in this field, and effectively once you've built a sort of a delivery base. So if your operations, at the moment, our operations are mostly in the UK, South Africa, and some delivery out of Europe and India. Those are focused on our existing client base. But if you look at Teleperformance, for example, they have operations in Southeast Asia, in Latin America, in North America. And once you've established that fixed cost, it's about layering in revenue. And if you work for a global client, then you just sort of, you tend to build your margins on that leverage. So as I say, it's about making sure we've got an efficient delivery center, and there's more work to do there. Then it's about going out and winning bigger contracts, and that in itself will drive margins if you do it on a more efficient basis. So continuing to use digital, continuing to reduce the property footprint are drivers of doing that. And then, yes, over time, it's about sort of finding niche areas that are growing and can afford higher margins. So technology as a market would be something interesting and an area to move into potentially.
Okay. Jumping back to the financials here, question here on the Capex, and I guess asking for a bit of clarification. Why is Capex forecast to grow to high levels, and could you confirm if this is the case, given that the group is shrinking in recent years following disposal of non-core businesses?
It's not really. I mean, I think generally we expect Capex to settle at around 2 to 3% of revenues, which is what peers tend to invest in the business on an ongoing basis. So for us, that's sort of 60 to 70 million pounds a year. I think at the moment, some of that Capex is being consumed by the portfolio business as we need to invest a little bit in those to ensure we get a decent price for them. In the same way that we did with ESS a couple of years ago, that needed some investment in moving into the cloud. In terms of sort of the underlying business, will absorb a little bit of the other Capex, but as I say, 2 to 3% is broadly speaking what we'd expect.
Okay. I think we've got time for a couple more questions here, so I'll try and rattle through a couple more. How much of the current year revenue forecast is already committed?
I think sort of if you look at, broadly speaking, at the order book and framework revenue, it tends to represent about 2/3 of our total revenue.
Okay, thank you. I think you touched on this in the presentation, but there's a question I think that as a follow-up to come back to it, which is where are you in terms of working from home as opposed to in the office? Perhaps you could give us a figure for the percentage of days worked and what sort of benefit is likely to accrue to you from that move.
Yeah, I think, as I said earlier, it's kind of at a broad guess. I think about 25% at the moment across a working week. But as I said, I'm not sure if that's us or the wider market. I mean, yeah, the benefits, as I said, are most people can continue to do their work just as efficiently from home. Look, I think there are also benefits of being together in an office. So whilst you might spend, I mean, I tend to be in the office maybe a couple of days a week, and those are good for things like client bidding processes, understanding client needs, salespeople getting together to discuss those. But at the same time, there are obviously significant savings, not only in property, but in things like sort of travel costs, if people are at home.
Okay, thank you. And I think we've got time for one last question. And you've talked about quite a lot about the debt reduction and how that's going. So there's a question here that says, is there a scenario you can envisage where the group will be debt-free?
Yes. As I said, I mean, if there are various assumptions in here, but assuming we've disposed, let's say we've disposed of all a portfolio by half year next year, and got a reasonable valuation for those businesses, then the business should be more or less debt-free at that point. Brilliant.
Stuart, thank you very much for that presentation. Thank you for answering all of those questions as clearly as you have done. We've now come to the end of the time today. I just want to flag up a couple of things. As you leave today, there is a survey. We'd really appreciate it if you could just spend a couple of minutes answering that survey. I know management do appreciate your feedback, so if you could do that, that would be very helpful. And I just wanted to flag up a webinar coming up actually tomorrow, and that's with Check It PLC. So thank you to Stuart for presenting today, and thank you for everyone attending. And we hope to see you all soon. Thank you, and goodbye.